Hey everyone, and welcome back to The Financiist. Today, we're diving into a really hot topic that's been making headlines. The idea that the US economy is slowing down and that Europe might actually start to outperform it. This comes from some big players in the finance world, like Invesco, who are saying there's no doubt about a US slowdown. So, is this for real? Could we be seeing a major shift in the global economic landscape? Let's break it down. For the past decade, and especially since the 2008 financial crisis, the United States has been the undisputed champion of economic growth among developed nations. While Europe was grappling with sovereign debt crises, sluggish growth, and complex political issues, the US was roaring ahead, powered by its tech sector, a flexible labor market, and aggressive monetary policy from the Federal Reserve. American companies like Apple, Amazon, and Google became global titans, and Wall Street consistently outperformed European stock markets. It was the American exceptionalism story, and for a long time, it was the only story that mattered. But things are starting to look a little different now. The very engine that drove US growth is now sputtering. The Federal Reserve, in its fight against record high inflation, has been hiking interest rates at a pace we haven't seen in decades. Think about it. When you raise interest rates, it becomes more expensive for businesses to borrow money to expand, and it becomes more expensive for consumers to get mortgages or car loans. This is designed to cool down the economy, to slow down demand so that prices can stabilize. And it's working. We're seeing signs of this slowdown everywhere. The housing market has cooled off significantly. Big tech companies, the darlings of the stock market, have announced hiring freezes and even layoffs. And consumer spending, which is the backbone of the US economy, is starting to weaken as people feel the pinch of higher prices and higher borrowing costs. So when a major investment firm like Invesco says there's no doubt the US economy is slowing, they're looking at all this data. They see the writing on the wall. The era of cheap money that fueled the last decade's boom is over, at least for now. The key question is whether this slowdown will be a soft landing, which is a gentle tap on the brakes, or a full-blown recession. The jury is still out on that, but the risk of a recession in the US is definitely higher than it has been in years. Now let's pivot across the Atlantic to Europe. For the longest time, Europe was seen as the sluggish, bureaucratic counterpart to the dynamic US, but the tables might be turning. It's not that Europe is suddenly a paradise of booming growth. It has its own serious challenges, especially with the energy crisis sparked by the war in Ukraine and the ongoing inflation problem. However, there are a few key differences that might give Europe an edge in the coming year. First, let's talk about the starting point. European economies and markets were already valued much lower than their US counterparts. Think of it like a race. The US has been sprinting for a long time and is getting tired, while Europe has been jogging at a slower pace and has more energy in reserve. Because US stocks were so expensive, they had a lot further to fall. European stocks, being cheaper, are seen by some investors as having less downside risk and more potential for upside. This is what we call a valuation argument. Second, there's the policy response. The European Central Bank, or ECB, has been much slower and less aggressive in raising interest rates compared to the US Federal Reserve. They started later and their hikes have been smaller. This means that European businesses and consumers aren't feeling the same intense squeeze from borrowing costs that Americans are. This gentler approach could allow the European economy to avoid a deep recession, even as it navigates its other challenges. Third, and this is a big one, is the fiscal response. The European Union has launched a massive recovery fund called Next Generation EU. This is an 800 billion euro package designed to invest in green energy, digitalization, and public infrastructure across the continent. This is a coordinated, government-led investment push that the US doesn't really have on the same scale. This spending can act as a powerful buffer, creating jobs and stimulating economic activity even as other parts of the economy slow down. It's a direct injection of fuel into the economic engine. And finally, let's look at the energy situation. This might sound counterintuitive because Europe was hit hardest by the spike in natural gas prices. But the crisis has forced Europe to accelerate its transition to renewable energy at an incredible speed. This massive investment in wind, solar, and energy efficiency isn't just good for the planet. It's a huge economic stimulus. It creates new industries, new jobs, and makes Europe more energy independent in the long run. While it's painful in the short term, it's forcing a structural transformation that could pay huge dividends down the road. So let's put it all together. What does outperform really mean? It doesn't necessarily mean that Europe is going to suddenly start growing at 5% a year, while the US shrinks. It's all relative. Outperform could simply mean that the US economy slows down to, say, 0.5% growth, or even enters a mild recession, while Europe manages to eke out 1% growth. In that scenario, Europe has outperformed. The same applies to the stock markets. If the S&P 500 is flat for the year, but the European Stoxx 600 index goes up by 5%, Europe has outperformed. This is a classic case of expectations versus reality. For years, everyone expected the US to be the winner. Now those expectations are being revised downwards. At the same time, expectations for Europe were so low that there's more room for a positive surprise. Investors are always looking for the next growth story, and when the main story starts to fade, they look for alternatives. Right now, some are betting that the alternative could be Europe. Of course, this is not a guaranteed outcome. There are huge risks. A harsh winter could send energy prices soaring again in Europe. The war in Ukraine could escalate, and inflation could prove more stubborn than the ECB expects, forcing them to hike rates more aggressively after all. Any of these could easily derail the Europe outperforms narrative. Similarly, the US economy might prove more resilient than we think. The American consumer might keep spending, and the Federal Reserve could successfully engineer that elusive soft landing. So what's the takeaway for you? The main thing is to understand that the global economic picture is getting a lot more complex. The era of clear US dominance is being challenged. This doesn't mean you should sell all your US stocks and pile into European ones, but it does mean that it's more important than ever to have a globally diversified portfolio and to pay attention to these shifting dynamics. The world is changing. The assumption that America will always be number one is being tested. The argument that Europe is poised to outperform is based on a compelling mix of valuations, policy differences, and structural changes. It's a bold call, and it's far from a sure thing, but it's a possibility that we need to take seriously. It shows us that in the world of economics and investing, nothing stays the same forever. The underdog can sometimes have its day. What do you think? Are you buying the story of a European comeback? Or do you think US exceptionalism will win out again? Let me know your thoughts in the comments below. It's a fascinating debate, and I'd love to hear your perspective. Thanks so much for watching. If you found this breakdown helpful, please hit that like button and consider subscribing for more deep dives into the economic trends shaping our world.